What stocks, ETFs are you personally bullish on?
Am I personally bullish on stocks or ETFs? Listen, I like Nvidia above 500. For me, it's about finding risk versus reward opportunities that are skewed in my favor. Like, this is a very selfish endeavor, is what this is. We are trying to make money, period. Nothing else matters. When you invest, that is the goal. So if the goal is to make money, and that is my only goal, then what I want to make sure that I'm doing is not losing money, right? Warren Buffett, rule number one, don't lose money. Rule number two, don't forget rule number one, right? That's Warren Buffett, somebody who's made a lot of money, by the way. So don't lose money. So we always want to enter a position and know where we're wrong, how much we could possibly lose in a worst case scenario, and be okay with that. Because that really goes a long way, number one, in keeping your money. But number two, mentally, like it takes away so much mental stress knowing you have a plan, you fully anticipate and just sticking to that plan. No big deal, just another trade, move on to the next one. Like, people get so emotionally attached. Oh, I'm never going to sell my Amazon. It's not your Amazon, first of all. Just because you own it, maybe you made some money. It's not your Amazon, right? You could press a button at 8 years or more, right? And it's not yours. People like have this emotional attachment to a stock, especially if it made them money once, right?
Yeah.
God forbid. We're dating. We're not marrying anything, right? These are and the minute they start pissing us off, I'm out. See ya, right? Bye, Felicia, right? No emotional attachment whatsoever. So I like Nvidia above 500. And by the way, if Nvidia is below 500, I don't want anything to do with Nvidia. Not my problem anymore. Now it's somebody else's problem. Literally. Goodbye. If it's below 500. Above 500, I like it. I like the relative strength. I like the fact that it's consolidated for 5 months before recently now just breaking out. It's the strong group. Just generally speaking, semiconductors are above their prior cycles highs, making new all-time highs. So it's a leading group. It's not like I'm trying to get cute buying, right? So I like Nvidia as a trade for sure. 500 target up near 750. So that's like another 40% higher, something like that.
Yeah. Yeah.
Good and good risk reward. I mean, obviously it's taken off a little bit. The bet was to buy it on a breakout above 500. So we're a little bit extended from there, but nevertheless, that's the direction that we're heading in. Take a look at some of these industrials. You see the strength in some of these European countries. A lot of that is driven by industrials, things like France and Denmark. These are like we have almost 30% technology in the S&P 500. Over there, it's like 27% industrials, right? Just to show you, like, as important as technology is for us, industrials is to them. And you're seeing new all-time highs in those countries. And it's not coming from tech, right? Because they don't have any tech over there, right? So
when you were talking about the options market, I wonder what are the differentiating factors that'll make you decide, yes, I'll go with the stock, or whether I'll go with the option. You said volatility is the bid, the ask,
of course,
and obviously the strike. Is there a percentage that will deter you from saying, all right, I'm going to go with the option on this? Like, what is that decision process for you?
Yeah. So let's just say we're bullish a stock, right? And volatility is high, right? So if volatility is high and we're bullish a stock, then we could buy the stock, right? But what if there's no well-defined risk in the common stock? It's kind of just in a range and there's no well-defined risk. How do we define our risk on the common stock? We really can't. So we have to go to the options market. So now in the options market, if volatility was low, we could just buy a call option, right? Go out as far as possible, just buy a cheap call, easy peasy, nothing, because volatility is low. But let's say in this example, volatility is high. So now we can do a few things. We could buy a call and then help pay for that by selling a further out of the money call to pay for that call because it's expensive. It's a high volatility regime, right? Or if we're really bullish and we really want to be a little more risky, we can sell an out of the money put, right? And take that cash to pay for the out of the money call, right? So there's a variety of different things we can do in a higher volatility environment. Now, if we're doing a risk reversal like that and we're selling an out of the money put, if at any point the price of the stock breaks below and closes below our strike on the put, all bets are off, right? And that's the risk management on something like that. So every type of strategy, there's a reason why we do that one instead of another one. And there's always a different risk management procedure in place before we even enter the trade. Like, let's just say that we're selling a 21 put and the stock's at 23. If at any point the stock breaks below that $21, one time, that's it. Unwind the trade, all bets are off. And we know that going in. Like, and in a call option, for example, we know that we're limited partners. No matter what happens, we can't lose more than what we paid for that call option. That's it. No matter what happens, the world comes to an end, can't lose more than the 75 cents or whatever that we paid for those June calls. You know what I mean? Like, and we're cool with that. Let it go to 0. I'm good with that, but could go to 10. Right?
And in that scenario, what is your percentage target that you're looking for? Because I think that'll help the audience a lot.
Sure.
I like risk reward scenarios of 1 to 5, 1 to 11. But for each of those staggered strategies, what is the risk profile that you're putting on for your targets?
Right. So it depends on the strategy, right? So in a lot of cases, we're not trying to capture much. We're just trying to capture the volatility, because in a higher volatility regime, it pays to collect income, right? Because volatility is more expensive. So in that case, the risk versus reward is not going to be great, but the probabilities of success are going to be really, really high. So you're collecting income. The income is not going to change your life. It's not going to be a 30 to 1, you know, a 30 bagger. You know, it's not that at all. It's actually the exact opposite. It's a much higher probability of success trade, but you're limited in how much money you're going to make. You see what I'm saying? But that's the type of strategy that works really well in a high volatility regime, a high probability bet where you're just collecting cash, just making it rain, just selling calls and puts all day long. Just keep them going, right? So that's the strategy in a high volatility regime. Now, on the other hand, in a low volatility, you can go out and buy calls for nothing, and you can go out 6 months or 8 months or even longer in some markets, and you get huge winners, winners. But these are two completely different types of strategies that are best fit for different environments. Now, if you're trying to get that 30 bagger, you know, call option going out a year in some stock in a high volatility regime, you're going to pay a fortune. Like, you're going to pay so much money. Like, good luck getting that money back, no matter how well the stock does, right? Because it's so expensive. So that just doesn't make any sense in that environment. You're better off just collecting the income, right? Sell calls, sell puts all day long. So in the case of, like, let's say we sell a strangle. So in a strangle, the stock is here, right? At the money. You're selling it out of the money call option, and you're selling it out of the money put option, right? You're selling the wings, and you're collecting that income. Let's say we collect $3. Let's say it's $1.50 each one. Let's just say we're collecting $3. If at any point we can buy back that strangle for half of what we collected, we unwind the trade right away. So we collect $3. As soon as we can collect $1.50, unwinds the trade. In fact, we place resting orders as soon as we sell the strangle. We also put the resting orders to buy the strangle back at $1.50 in that case right away. So is that going to be a 30 bagger trade? No, at all. We're just betting that volatility is going to just keep eating at the people buying calls and puts that are just churning their accounts, right? Because they can't help themselves but buy calls and puts. We'll just accept their donations.
So can you explain that a little bit? Can you explain that a little bit more? Because a lot of people might be new to
but it's a hell of a gym. Yeah.
All right. So,
sometimes you're betting that the stock doesn't go up or down. It just kind of
So I'm gonna kind of give some framework, and then you can kind of just fill in the blank. So when you say like out of the money call, so like let's say Apple is at 185 right now, so that would be, let's say, like a 220 call on Apple, right, for 2025 or something like that, right? Where it's out of the money, not in the money. Where in the money would be like 288, 285, like where it's at right now, right? So you're buying a 220 call on Apple for 18 months down the road. Let's just hypothetically use this as an example, right? So when you say you're selling, can you just kind of like elementary level explain what that is?
Beginner.
So these options, right? They have an element of intrinsic value, which is when you're in the money, and you have an element of time value, right? So if a stock is at 200 and these 250 calls, let's just say $50 out of the money, they don't have any intrinsic value. It's only time value, right? That's the only thing you're paying for is time, because it's not in the money. Something that might be $10 in the money, you're paying for that $10 of intrinsic value, and the rest is time, right? Now, as the expiration, right? June expiration, July expiration, whatever, as the expiration gets closer, the rate of deterioration of that time value increases, right? So once you get to that 45 to 60 days until expiration, these are calendar days, 6 to 8 weeks to expiration, that's when it really appreciates, starts deteriorating very quickly. So if you're if you're long options, you own those options, that's the period where you're going to be losing the most time value the quickest. So if you're on the other side of that trade and you are taking advantage of other people's premiums deteriorating, that's income for us. So if we're looking for that 45 to 60 day out sweet spot when we're selling those options, right? So that's how we decide the expiration for those particular strategies. As far as the strike prices, we'll look for a range bound. It'll be a range bound market where there'll be resistance above and support below, and the price is kind of somewhere in the middle. So essentially the bet is that the price of the stock or ETF remains in that range. It's not an uptrend or a downtrend. It's just a mess, and it's going to stay a mess. And people are going to bet that it's going to be, other people are betting that it'll trend. We're betting that it'll stay not trending, right? Essentially is the bet there. So we'll sell a call option on the upper end of that range, and we'll sell that strike. And then we'll sell the put option of the bottom end of that range, and we'll sell that put.
Is there a technique or strategy that you prefer over the other? Is it the time decay, or is it the intrinsic value? Meaning, like, are you doing short term, or do you prefer leaps, meaning they go 6 months to 2 years out? Is there one that you
selling?
If you're buying?
Right. So if I'm selling, we want to stick to that 45 to 60 day period, because that's when the premium really deteriorates and we want to collect that cash. If I'm buying, I'll go out as far as possible. Like, it depends. Like, I remember a couple of years ago, we bought Chevron calls 2 years out for like nothing. It was a joke. It was like $2 for like 2 years, like $10-15 out of the money. It was like a joke. So what we do is whenever we buy calls like that, whenever it doubles, we're actually doing less of that these days because we want to be greedy. That's like our new strategy, is be greedier. But that's a whole nother thing. Historically, what we do, and we did with Chevron, is that as soon as the call option doubles, we sell half, right? And then we keep the rest as long as we want. We collected our money back, and now it's just house money. Part of our strategy this year is to not do that and be more disciplined with maybe raising stops, so that we can still capture without necessarily, so we've been toying with that internally. So as you could see, it's a good example. Like, no matter how long you do this, you're always tweaking, you're always adjusting and doing new things. And I roll my eyes because we're being greedier. Like, as a team, we're like making this conscious decision. It's just funny.